This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Surprise decline. Shipments of Apple's flagship product, the iPhone, fell, ramping up pressure that its next model be a blockbuster.
We will work incredibly hard to re-earn not your business necessarily, but your trust.
United CEO apologizes again for that infamous incident last month when a doctor was dragged from his flight. But lawmakers made it clear that either he fixes the mess or they will.
Deep cuts. Kansas slashed taxes to revive the economy. But what happened next? Those stories and more tonight on Nightly Business Report for Tuesday, May 2nd.
Good evening, everyone, and welcome. Well, the numbers are enormous, but perhaps not enormous enough. Apple, the world's most valuable publicly traded company, sold more than 50 million iPhones in the most recent quarter. That was a decline, though, from a year ago. Oh, that could be a sign that consumers are actually just waiting to spend their money on the next 10th anniversary edition of that smartphone. Let's get right to the numbers right now. This is the late news of the day. For the quarter, Apple earned $2.10 a share. That was 8 cents better than forecasts. Revenue up from a year ago to nearly $53 billion in 3 months. But that revenue number missed expectations slightly. That sent shares lower in initial after-hours trading, as you see there. But there's more. Apple boosted its dividend by 10.5% and its share repurchase program by $35 billion. It is also sitting on, get this, more than $250 billion in cash.
So what will all of this mean for Apple's stock? Nancy Tengler, Chief Investment Officer at Heartland Financial, joins us now to talk about that. Welcome back, Nancy. Nice to have you here.
Thank you, Sue.
You have been very bullish on this name for some time. Does the, not miss necessarily, but the disappointment in unit sales worry you at all or not?
Not entirely. I mean, one of the things that Tim Cook said, Sue, is that he also drew down inventory. So the miss wasn't really 2%. It was more like half of 1%. But I do think your lead-in is correct, that consumers are sitting on the sideline, and that until the iPhone 8 comes out. And what investors should be thinking about is the two reasons they own stocks: dividend and dividend growth, and capital appreciation. And Apple has delivered on the capital appreciation over the last year. As it takes a breather, we think that investors should be counting on the dividend.
Is this really, Nancy, now fundamentally a one-product company? It's almost as though the iPad and the Mac are afterthoughts.
I think you're right about that, Tyler, but if you look at services grew at 18% last quarter, and that's the second largest revenue line item for the company.
Yeah.
Yeah, so it's iPhones and services, and what we hope to see is some new products, right? I mean, that's what everyone's waiting for.
Now, would you accumulate this stock on weakness? Because it did sell off a little bit after the results were announced. Would you be in buying the stock if you're a long-term investor?
Yes. So we have, as portfolio managers, we have to follow certain guidelines, right? So the stock had gotten to about 6% of our portfolios, and we recently sold it back to 4.5% or 5%, depending on the strategy. If the stock sells off more than 2%, which is where it was when I looked last, we'll be back in picking away at it to round our holdings back up and then hold on again for the next move. But it's not going to take off in the next few months. So I think investors have time to accumulate at lower prices and then hold on for the next 3 to 5 year period, because this company is doing a lot of things right, and there's a lot of skeptics. And so when the skeptics, you know, at $89 when I was recommending it, I took a huge beating, and I'm certainly glad. I wished I'd bought more.
All right, on that note, Nancy, thank you for joining us. Nancy Tengler with Heartland Financial.
On Wall Street, a small gain helped push the Nasdaq further into record territory as investors assessed today's mixed bag of earnings reports from corporate America. And the Fed started a 2-day policy meeting. More on that one in just a moment. The Dow Jones Industrial Average rose 36 points to 20,949. Nasdaq added 3, the S&P 500 up 2.
Those mixed earnings were reflected in results from Pfizer and Merck. Pfizer, the largest U.S. drug maker, said soft sales of some key drugs weighed on revenue, which missed estimates. Legacy medicines lost market exclusivity, though the company did report better than expected earnings thanks to reduced costs. Rival Merck saw its profit top expectations. The drug maker raised its full-year revenue and earnings forecast and said a key cancer drug is gaining market share. So, as you might expect, shares of Pfizer and Merck moved in opposite directions.
A weak month for auto sales also weighed on the market today as Americans didn't buy cars in April at the pace they had been. General Motors saw a nearly 6% drop in monthly sales, Fiat Chrysler a bit more than that, and Ford sales down more than 7%. Declines could signal that demand is slowing after 7 straight years of sales growth. Automakers are also offering more deals so that they don't lose sales in the very hot SUV market. Increased incentives is a concern for investors, and they sold shares off today of the automakers in trading.
From driving to flying, after a stream of incidents where airline crews had altercations with passengers, Congress called industry leaders up to Capitol Hill, including the CEO of United Continental. Lawmakers today asked them why flying in America has so many problems. As Phil LeBeau reports, the questions came with the threat of more regulations to protect passengers. Phil LeBeau is in our nation's capital tonight.
For airline executives, most notably the CEO of United Airlines, Oscar Munoz, the message was clear. Americans are fed up with the flying experience.
I guess my first question I was going to ask, only slightly in jest, is why do you hate the American people? But I'm not going to ask that. I was going to ask how much you hate the American people. I'm not going to ask that either.
We have a problem that shouldn't be as bad and unpleasant as it is. And you're the only people that can fix it.
The hearing comes 3 weeks after Dr. David Dow was dragged off a United Airlines plane because he refused to give up his seat on an oversold flight. United has since settled with Dr. Dow for an undisclosed amount, but Oscar Munoz is still apologizing for what happened.
And in that moment, for our customers and our company, we failed. This has to be a turning point for the 87,000 people and professionals here at United. And it is my mission to make sure that we make the changes needed to provide our customers with the highest levels of service. If we break it, it's incumbent upon us to fix it.
United says it is reducing the amount of overbooking it does on its flights, and Southwest will completely stop doing it next week. But other airlines are hesitant to give up the practice. They say it keeps flights full and airfares down. But members of Congress say none of that matters if passengers are left without a seat they thought they had reserved.
That should be the takeaway from today, is seize this opportunity, because if you don't, we're going to come and you're not going to like it.
Some on Capitol Hill may push for more rules to protect passengers, but don't expect too much. After all, this is a Republican-controlled Congress, and there is a Republican in the White House who has promised to ease, not increase, regulations on companies. Phil LeBeau, Nightly Business Report, Washington.
Federal Reserve policymakers began a 2-day meeting today with a statement on interest rates expected tomorrow. But many on Wall Street are looking past this meeting and ahead to possible moves later this year. Steve Leisman has more.
Wall Street not expecting much from the Fed tomorrow, but debating what happens with monetary policy the rest of the year. 98% of respondents to the CNBC Fed survey expect the central bank to stay on hold at its meeting this week. But looking ahead, 65% say the next rate hike is in June. Some say a little bit later. 53% say there'll be 3 rate hikes this year. Some say 2, some say 4. But 71% say the balance sheet, that $4.4 trillion of assets the Fed has, it will begin to decline by January 2018. As for where the Fed funds rate goes, we're at 0.88 now. Look for 1.4 in 2017, 2.2 in 2018, 2.7 in 2019, and we get up to that long run rate, call it 3%. Thereafter. That's where the long run rate is supposed to be. As for the outlook for stocks, you can see not much more expected from current levels this year. Just about a percentage point is the average forecast for the S&P to 2409, but a little more next year, a 7% gain seen from current levels to 2564. The reason is because they've moved the expectations for fiscal policy from the Trump administration from 2017 to 2018. And now, looking ahead at what's behind the rally, Back in December, 18% thought it was economic fundamentals and earnings, and 82% said policy expectations. Big change in that right now. 50% say it's economic fundamentals and corporate profits. 48% say it's policy expectations. Respondents look for 2.25% GDP growth this year, with a small bump from fiscal policies from the Trump administration. The biggest risk, though, protectionist policies from the Trump administration. For Nightly Business Report, I'm Steve Leisman.
Still ahead, the great tax debate.
Milan Mui in Topeka, Kansas, where a real-world economic experiment is taking place, and the results are dividing the business community. That's coming up on Nightly Business Report.
The tax plan released last week by the Trump administration looks quite similar to the tax reform Kansas voted into law a few years ago. Ilan Mui traveled to Topeka to see how those steep cuts are playing out.
It's been called the Kansas experiment, a package of deep tax cuts that the governor promised would be a shot of adrenaline for the state economy. Instead, it's blown a $1 billion hole in the budget, cut funding for schools, and divided the business community. 5 years ago, Kansas cut personal income taxes and became the only state in the country where small firms, known as pass-throughs, have a tax rate of 0. It was a real-world test of the controversial economic theory that tax cuts lead to growth. But almost immediately, the drumbeat to get rid of them began. Now, more and more businesses are speaking out against it, even though it benefits them. Matt Condon, a local entrepreneur, runs one of them.
Like many things in government, there are unintended consequences of laws that were passed with originally positive intent.
I want to see 400 plus what?
That's because the state is in a budget crisis, a $1.4 billion shortfall over the next 2 years. And unlike the federal government, Kansas has to balance its books. Schools are getting hit particularly hard. Kansas City, Kansas is one of the districts suing the state over lack of funding. School's Chief of Staff David Smith said if they can't come up with a compromise and come up with more money, by June 30th, the system could shut down.
More than 80% of our kids live in poverty. They are the kids who most depend upon school for their future success, and so we feel like it's our responsibility as the adults to give them whatever they need. It's been a challenge. We've really had to struggle, both sacrificing money in some places in order to make sure our kids get what they need.
There are businesses fighting to keep these tax cuts alive. Winger Manufacturing is a family business that makes food processing equipment. They've reinvested $18 million from these tax cuts back into new technology and new jobs.
The current pro-business environment in Kansas allows companies like Winger to continue to grow and expand. That translates into continued jobs for people in this and other communities.
Governor Sam Brownback says that's evidence of the policies he ushered in 5 years ago are succeeding.
If you want to get people back to work, if you want to get America working again, cut taxes on small business.
The Republican-controlled state legislature passed a bill earlier this year that would have repealed the cuts, but Kansas Governor Sam Brownback vetoed it. He blames the state's budget woes on the downturn in the agricultural and oil industries instead.
And those are so big pieces of our economy that the tax policy couldn't overcome the big global commodity drops in prices.
Nationally, though, his ideas are gaining traction. The White House is taking a page from the Kansas playbook, proposing big reductions in the tax rate for small businesses all across the country. But here in the Sunflower State, momentum is moving in the opposite direction. Schools, businesses, and even many Republicans say they've had enough. State lawmakers are convening here this week to debate once again whether to repeal these tax cuts and put an end to the Kansas experiment. For Nightly Business Report, I'm Ilan Mui in Topeka.
Fewer discounts helped results at Coach, and that's where we begin tonight's market focus. The luxury handbag maker reported profit that rose and topped estimates, thanks in large part to the company's push to scale down on promotional activity. And as Coach removed its brand from hundreds of department stores, revenue took a hit, but sales were still above estimates. The company also reaffirmed its guidance for the year. Coach shares jumped 11% to $43.15. Aetna said costs related to its failed merger with rival Humana caused a loss in its latest quarter. Still, the results were better than expected. Following its exit from many Obamacare markets, the company said it's still assessing its future participation in the government exchanges where it currently offers plans.
We expect to lose around $200 million, $220 million this year on the exchanges, with only a quarter of the membership we had last year, which sort of substantiates our view of a year ago when we withdrew from a number of other exchanges that we had the potential to lose as much as $900 million. And we're sort of on that track. So we're evaluating those markets as we speak.
Aetna also raised its 2017 earnings forecast, and with that, shares rose more than 1% to $138.91. Molina Healthcare said it was replacing its CEO and CFO, who are the sons of the company's founder. Molina Health said the moves were the result of a, quote, the company's disappointing financial performance, end quote. Both executives are expected to remain on the board. The company will immediately begin searching for a permanent CEO. Wall Street liked the move, sending shares up more than 17% to $59.75.
The hardwood flooring retailer Lumber Liquidators said a rise in average transactions helped overall sales improve and top expectations. The company also posted a narrower loss, but that one missed targets. Shares plunged as a result, more than 13%. They finished at $21 and a nickel. Infosys is pledging to create more jobs in the U.S. The India-based information technology company said it will bring on 10,000 American employees over the next 2 years, with plans to begin the hiring in Indiana. Infosys also said it will build 4 technology hubs across the country. Shares down fractionally at $14.52. Meantime, shares of Advanced Micro Devices were crushed today following the company's disappointing profit outlook. That one came out after the bell yesterday. The computer processor developer swung to a loss in the latest quarter and reported revenue that was in line with estimates. Shares down more than 24%. A bad day there, $10.32 the close.
As we've reported, President Trump yesterday said he was looking into breaking up the large banks by reviving an old law that prohibits commercial banks from engaging in investment banking. Last month, the president's top economic advisor, Gary Cohn, reportedly said something similar. And some Democrats, including Senator Bernie Sanders, have supported the idea. So while the concept is not new, the drumbeat is getting louder.
But politics aside, would breaking up some or all of the Wall Street big banks make shareholders richer? Dick Beauvais, Vice President of Equity Research at Rafferty Capital, says no, a breakup wouldn't make the assets worth more. But Lindsay Bell, investment strategist at CFRA Research, disagrees. She says it would. Folks, welcome. Dick, you get to go first. Why is this not a good idea for shareholders? I can see why it's a good idea for investment bankers. They make fees.
Well, it's not a good idea because it's not a good idea for the customers. In other words, if you think about it, if you start to lose the scale advantages of big banks, the prices of the products that they sell tend to go up. Secondly, if you take away the cash flows that they have, the innovation that they have to bring things like mobile banking go away. In addition, if you start thinking about the history of banking, that you know that for roughly every day, going back to 1987, we've lost one bank in the United States. Why? The reason is because they're one-trick ponies. You have to have more than one set of products in order to be successful in this business.
All right, Lindsay, you disagree, and you say that the banks, it would be a positive move and it would make them more valuable, which should benefit shareholders.
Yes, we think that breaking up the banks, our view at CFRA Research, is that they would be more valuable as separate entities. The fact of the matter is the increased amount of regulation and the large amounts of capital that these banks have to hold and are restricted to use has really created underperformance for both sides of the bank. And to Dick's point, I think that if you break up the banks, you will create more competition, which will help keep prices down.
But what about Dick's point that there are benefits from the scale, that they allow innovation, they allow some products to be sold less expensively? Address that one specifically.
Well, I think innovation is something that these banks are, both sides of the bank are keenly zoned in on. You know, fintech companies are coming in here and, you know, potentially they are disrupting this industry left and right. So you see these banks, big banks, cutting expenses across the board, but this is one expense on innovation and technology that they will not cut because they know that they need to keep up with it, to keep up with innovation and keep their customers happy, because that's what the customer demands.
What about that, Dick?
Well, basically, if we take a look, I'd like to go back on one point that Lindsay just made. In the years 2014, 2015, and 2016, the banking industry in the United States had all-time record profits. They had all-time record profits operating under these, if you will, regulations and limitations created by the government. So the fact of the matter is that the limitations that were placed on the banks by the government did not restrict them. They also were able to provide the lending power that the economy needed. That was not, you know, there was no sector of the economy that needed, if you will, loans that didn't get it. And so the fact of the matter is that, you know, if you crimp these companies, if you take away their cash flows by reducing their size, you make them more risky for the American taxpayer. You do that because there is no FDIC insurance, you know, for all segments of the entity, number one. And number two, you know, these companies, when you see interest rates rise sharply, if history is any gauge, they go out of business. In addition, if you run into a recession, they go out of business.
Okay.
So
Lindsay,
we've got a good system.
Lindsay, you get the last word there. Why don't you address particularly Dick's point about the regulatory burden, which seemed to be sort of central to your argument? Might these banks make even more money broken up if the regulatory costs were, as a result, lower?
Yes, I think they would. And in fact, I think you would see, if you looked at the stock performance of these banks over those several years, they lagged the broader market, and they have popped since the election, since Donald Trump was elected, given the fact that investors are expecting less regulation. So shareholders will certainly benefit. Return on equity for these banks has been in the low double digits for quite a while, which is very low by historical standards. So from that perspective, they will be making more money.
Lindsay and Dick, thank you very much for a very kind and polite conversation. We covered a lot of turf there. Appreciate it.
Thank you.
And coming up, celebrities head to Wall Street to make trades and raise millions for charity. Hollywood has averted a writers' strike. The Writers Guild of America and a group of studios and networks say they've agreed to a 3-year deal. The union told its 9,000 members that they would earn $130 million more over the lifespan of the agreement. Media analysts said any strike would likely have pushed more viewers to streaming services like Netflix and Hulu.
Sports stars, celebrities, fashion designers, they were all Wall Street traders for the day, all in the name of giving back. Bob Pisani reports from BTIG's trading floor in New York City.
The annual BTIG Charity Day raised millions for charity, but most importantly, it was a chance for dozens of celebrities to chat up their favorite cause.
Turn 2 Foundation, foundation that started 20 years ago. Yeah. Prevention of drug and alcohol use for kids.
I'm representing the Boys and Girls Club from Miami. That's where I learned how to play baseball when I was 10 years old. What's up, Reg? And it's a wonderful organization.
Well, I'm here with a charity that was founded by Nancy Carbone right after 9/11. It's called Friends of Firefighters, and they provide therapeutic services to firefighters that are active and retired, and for their families.
So I'm a new Goodwill ambassador for the UN Refugee Agency, and I've been working with them for years because we're having just an unprecedented crisis. We have 65 million people worldwide who are displaced, and over half of them are children. The UN is there to help them, and I just wanted to be part of that.
And Mark Cuban spoke about how artificial intelligence is changing the investment landscape. And then, surprisingly, he cited Twitter as an example of a company that was getting its act together with AI, harnessing big data to be smarter in ad delivery. That moved the stock 4%.
The key to artificial intelligence is data. And Twitter hadn't been able to harness the data to be smarter in how they deliver tweets and how they use information and how they deliver ads. Now they started to hire the right people. They're starting to get smarter.
The celebrities all lined up to make an honorary trade on the BTIG trading desk. The firm donates all its commissions to charity for the day.
It started out small with, a few Yankees coming here 14 years ago, and, it's really developed into something really special where everyone gives their time and energy to give back and show kind of the good side of Wall Street.
That humble beginning with a few Yankees has blossomed into a major event involving business leaders, fashion icons, actors, and sports celebrities that's raised over $40 million for dozens of charities, and it's getting bigger every year. For Nightly Business Report, I'm Bob Bassani in New York City.
For them.
Very nice.
For them.
Very
it
nice.
Is.
Well done.
On that note, that's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And thanks for me as well. I'm Tyler Mathisen. Have a great evening, everybody. We'll hope to see you back here tomorrow night.